welcome back to the Deep Dive. Now, if you're an investor, maybe a homeowner, or frankly just someone who's managed to sell something valuable, you've probably bumped into capital gains tax.
Oh, yes, CGT. It often feels like just, well, a fixed cost you have to bear when things go well.
Exactly, but it doesn't necessarily have to be that way. Today, we're going beyond the absolute basics. We want to look at the smarter planning strategies.
Strategies that can help turn CGT from feeling like just a drain into something you can actually manage, maybe even control as part of your overall financial plan.
Okay, let's unpack this. What exactly are we dealing with here? Our sources define it pretty clearly. CGT hits when you dispose of an asset and you realize a gain.
Right, and dispose is a really broad term. It's not just selling. Gifting counts. Swapping assets counts. Even getting insurance money for something that was lost or destroyed can count.
That's wider than people might think.
It is, and the crucial thing, the absolute key point, is that CGT applies to the growth in the asset's value, the appreciation. It's not a tax on your regular income like salary or dividends.
And that distinction, growth versus income, that's fundamental for planning, isn't it?
It's the bedrock, really. Understanding that is step one.
So, before we even get to the clever stuff, how do we work out that basic gain?
Well, the basic calculation itself is fairly straightforward on paper. You take what you got for the asset, the disposal proceeds.
Okay.
Then you subtract your allowable costs. That's mainly the original price you paid for it.
Makes sense.
Plus any associated costs like, broker fees if you bought shares. And this is really important for property, any documented costs of actual improvements you make. Not repairs, but improvement.
Right. Things that actually enhance the value.
Exactly. What's left after subtracting all that? That's your raw gain.
But that raw gain isn't necessarily the amount you pay tax on, because there's this thing called the annual exempt amount, the AEA.
Precisely, the AEA. Think of it as your personal CGT allowance each year. It shields a certain amount of gain from tax completely.
So you calculate the gain, then knock off the AEA.
And whatever gain is left after the AEA, that's your taxable gain. And that number, the taxable gain, is what we're aiming to minimize today through smart, proactive planning.
Got it. And looking at that AEA, it feels like the absolute cornerstone of planning.
It really is. It's a use it or lose it allowance. It resets every single tax year, April 6th. If you don't make gains up to that amount in a year, you can't carry the unused allowance forward.
It's just gone.
Gone forever. Which brings us straight to the first major strategy our sources highlight, timing.
Timing the disposal.
Yes. If you've got a big portfolio or maybe one large asset, say a property, that's shot up in value. Just selling it all in one go, in one tax year. That's usually not the best approach.
Because you only get to use that AEA once that year.
Exactly. You're wasting the potential to use it again in the next tax year.
But hang on, what about market risk? If you deliberately delay selling part of an asset until the new tax year just to get another AEA, couldn't the price drop in the meantime?
That's a very valid point. There's always a trade-off between tax planning and market exposure. But the strategy of spreading disposals, maybe selling some shares just before April 5th and the rest just after April 6th, it effectively doubles your tax-free allowance for that single disposal event, just split across the year-end. For many people, especially those with large predictable gains perhaps from gradually selling down a portfolio, the guaranteed tax saving from using two AEAs often outweighs that short-term market risk.
So you're locking in tax savings just by shifting the date by potentially a few days or weeks.
It's all about that careful timing across the tax year boundary. And timing isn't just about the AEA. It also massively impacts the rate of tax you pay on the gain.
Right, because CGT rates depend on your income tax band.
Correct. Basic rate income taxpayers generally pay a lower rate of CGT than higher or additional rate taxpayers.
So if selling a big chunk pushes your total income for the year, including the gain itself, into the higher rate band,
you suddenly pay a much higher percentage of CGT on that gain. But if you could split that disposal over 2 tax years,
you might stay within the basic rate band in both years.
Potentially, yes. So you get 2 lots of AEA and potentially pay the lower rate in both years. That's a double win from just timing it right.
That's clever.
And we absolutely have to mention residential property here. If it's not your main home, like a buy-to-let.
The rates are higher again?
Yes, significantly higher, up to 28% even for higher rate taxpayers, compared to 20% for other assets. So timing the sale of, say, a rental property needs really careful thought about your income in that specific year. You don't want to accidentally tip yourself into that top CGT bracket if you can avoid it.
That higher rate for property really highlights the need for planning. Which actually leads us nicely into using the family structure. Here's where it gets really interesting. Transfers between spouses or civil partners.
Yes, this is absolutely fundamental. It's probably one of the most powerful yet straightforward planning tools available.
So how does it work? If I just give shares to my spouse, isn't that a disposal?
Normally it would be, but transfers between married couples or civil partners are treated specially. They happen on a no gain, no loss basis.
Meaning no CGT is triggered at the point of transfer.
Correct. The actual act of transferring the asset between spouses doesn't create a tax bill then and there.
Okay, but surely the tax has to be paid eventually. What happens when the spouse who received the asset sells it?
Right. The receiving spouse effectively steps into the shoes of the transferring spouse. They inherit the original acquisition cost, what the first spouse paid for it way back when, plus any allowable costs.
I see. So the gain is still calculated based on the original cost, not the value when it was transferred between them.
Exactly. The gain crystallizes only when the asset is finally disposed of outside the couple.
And the planning potential here is huge, because now you can use both partners' annual exempt amounts.
Precisely. Let's say partner A has a big gain coming up, maybe £20,000, but they've already used their AEA on something else this year. Partner B hasn't used theirs.
So partner A transfers half the asset to partner B.
Partner B then sells their half. Partner B uses their own AEA to shelter their share of the gain. Instantly, you've doubled the amount shielded from tax for that year. That's a significant saving you'd completely miss otherwise.
And the other big advantage you mentioned earlier, differing tax rates.
Absolutely crucial. Imagine partner A is an additional rate taxpayer facing the highest CGT rates. Partner B, perhaps they work part-time or aren't working, is a basic rate taxpayer.
Transfer the asset to partner B before selling.
And partner B realizes the gain, potentially paying CGT at the much lower basic rate instead of the higher or additional rate. It's a perfectly legitimate way to ensure the family unit pays less tax overall, a cornerstone of planning for couples.
Okay, so we've timed things right. We've potentially used both partners' allowances and rates. But what if we could avoid CGT altogether on the growth? Like build a firewall around the assets.
That's the ideal scenario, isn't it? And that's where tax wrappers come in, structures that legally shield the assets inside them.
What are the main ones the sources point to?
The two big ones, the ones most people can use, are ISAs, individual savings accounts, and pensions. Most investments held within a pension wrapper grow free of CGT.
And ISAs, too. Any profit made inside an ISA is tax-free.
Completely free of capital gains tax and income tax, too, actually. The growth just builds up, untouched by the taxman, for as long as it's in there.
The immediate benefit seems clear, but what's the real impact over the long term, say 20 or 30 years?
Oh, it's enormous. The power of compounding really kicks in. Think about it. An investment growing outside a wrapper might make a gain, you sell it, pay 20% CGT, then reinvest the rest.
So less capital goes back in to grow next time.
Exactly. Inside an ISA or pension, 100% of the gain gets reinvested and starts earning returns itself. Over decades, the difference in the final pot size can be absolutely staggering. It ensures your growth isn't constantly being chipped away at.
And pensions have that extra benefit of tax relief on the way in, too.
They do indeed. So you get tax relief on contributions and then CGT-free growth inside. It's incredibly powerful for long-term wealth building.
While we're on exemptions, the sources mentioned others, too. What about your own home?
Right, principal private residence relief, or PPR. Generally, when you sell your main home, the gain is completely exempt from CGT. For most people selling their only home, there's no CGT to worry about.
But you said generally. Are there catches?
There can be. The main complexity arises if the property hasn't always been your main residence throughout the entire time you've owned it.
Like if you rented it out for a few years.
Exactly. Or if you lived elsewhere, maybe worked abroad for a period, or even if you use part of your home exclusively for business. In those cases, the relief might only apply partially, and the calculations can get quite tricky. You need proper advice there.
Okay. And the other one mentioned was chattels, personal belongings.
Yes, tangible, movable things. Think antiques, paintings, maybe jewelry, collectibles.
How does CGT work for those? Is my old furniture taxable?
Unlikely for furniture. But for valuable items, there are special rules. The key figure is £6,000. If you sell a single chattel for £6,000 or less, any gain is automatically exempt.
Simple enough. What if it's more?
If it sells for more than £6,000, it gets a bit more complex. There's a special rule that limits the chargeable gain. It's basically the lower of the actual gain, or 5/3 of the excess proceeds over £6,000.
Right, so it needs looking at carefully if you sell something valuable like art or antiques.
Definitely. You need to know if it qualifies as a chattel and how those specific rules apply.
All this complexity really drives home that planning isn't just about maximizing gains or using allowances. It's also about dealing with the flip side when investments go down. Capital losses.
Absolutely. Nobody likes making a loss. But if it happens, that loss can be a valuable asset in itself for tax purposes.
So a capital loss is when you sell or dispose of an asset for less than you paid for it, including costs.
Precisely. Less than its allowable cost basis.
How do you actually use that loss then?
Okay, first, you offset the loss against any capital gains you've made in the same tax year. So it directly reduces the amount of gain that's subject to tax that year.
What if your losses are bigger than your gains? Or if you have no gains at all that year?
Then the unused loss isn't wasted. It can be carried forward indefinitely to offset against gains in future tax years.
Okay, so it reduces future tax bills. But you mentioned something crucial earlier, the need to report it.
Yes, this is critical. You must report the capital loss to HMRC on your tax return for the year the loss occurred.
Even if you don't have any gains that year and don't actually owe any CGT? Why?
Because if you don't officially claim that loss within the time limit, usually 4 years from the end of the tax year the loss happened, you lose the right to use it forever.
Wow. So you could make a big loss, not report it because you had no gains that year, and then 5 years later make a huge gain.
And you wouldn't be able to use that old loss to reduce the new tax bill simply because you didn't report it back then. It's like throwing away a valuable tax voucher.
So reporting immediately is like banking the loss for potential future use. It's insurance.
Exactly that. It's a vital piece of administrative housekeeping. Report the loss, get it registered on your record with HMRC, and it sits there, ready to shield you from tax when you eventually make gains down the line.
This has been incredibly insightful. We've covered a lot of ground on the CGT planning toolkit. So what does this all mean? Well, we've really identified 4 key pillars for smart CGT planning, haven't we? First, strategic timing, spreading disposals across tax years to maximize that annual exempt amount.
Absolutely. Then using interspousal transfers, leveraging both partners' AEAs and potentially their different tax rates.
Third, sheltering assets where possible, using those tax wrappers like ISAs and pensions to let growth compound completely tax-free.
Crucial for the long term. And finally, diligently reporting capital losses straight away, even if you don't need them immediately, to make sure they're available to offset future gains.
That feels like a solid core toolkit.
It is. But remember, zooming out, CGT doesn't exist in a vacuum. Your residency status, for example, makes a huge difference. The rules change significantly if you're living abroad, even temporarily.
That's a whole other layer of complexity.
It is. And there are other specific reliefs, too, like business asset disposal relief, formerly entrepreneurs relief, which offers a much lower 10% rate for qualifying business sales. Very important for business owners.
And things like trusts and gifting assets for inheritance tax planning.
Exactly. That often involves things like gift holdover relief, which is another specialized area allowing gains to be deferred. All these specific situations really underline the need for tailored professional advice.
Definitely. It strikes me that underlying all of this technical detail is that fundamental point you made right at the start, the difference between income and capital growth.
It underpins everything in investment and tax planning.
So maybe here's a final thought for you, our listeners, to mull over. Beyond just ticking the boxes on allowances and wrappers, how does truly internalizing that distinction, income versus capital gain, affect not just the tax you pay year to year, but how you actually structure your investments, how you think about building and preserving wealth over the very long term? Getting that right might just change your whole financial outlook.